Good evening everyone and welcome to Admiral Markets webinar. Today is 8th of October 2014 and today we will talk about the multiple time frame trading. Why actually multiple time frame trading is good, how it can benefit your trading. Then I will show you some multiple time frame trading ideas, and this is the first part of the webinar, so in the next webinar I will show you the actual system for trading, but today you need to know the first steps, why MTF trading is important and why MTF trading can do you good. Actually, I have my own idea of MTF trading and I will present it today. So the thing is, all these things which we are going to talk about can really benefit your trading, especially because this is something which is probably new for you. But believe me, MTF trading works wonders if it's applied correctly. So before we begin, as always, our standard risk disclaimer, risk disclosure statement stating all possible risks associated with forex market. By accepting the risk, you're also proceeding further with me. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author, it's me, and in no way it represents the actual suggestion for the trade. These are not MBK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only, and this webinar is informational and educational purposes only. So we can say that we need to work out on MTF presented, various time frames explained, and MTF ideas. So we are going to talk solely about MTF trading. So MTF refers to multiple time frame. That means that you're actually trading of the higher time frames. Higher time frames will give you A, momentum, B, trend, C, actual entry. So if you want to trade multiple time frames, then you need to know that it will give you trend, momentum, and entry. Many years ago, I read a book called Momentum, Direction, Divergence, which was written by William Blow. You can try to Google it on the internet. And it actually where I learned to use multiple time frame analysis and momentum on MACD. So William Blow described it greatly in his book, how to use actual, let's say, MACD for spotting momentum, direction, and divergence. And that was where my inspiration came from. That was the first contact with MACD indicator, and actually I really use it when I do my analysis for intraday. As you see, sometimes I do 1 hour time frame analysis. No, the actual analysis is done on 1 hour time frame, but what I do is I always watch higher time frames, and I do trading on 1 hour. But the thing is, I watch out for those higher time frames to give me the possible entry. So MTF trading refers to same pair on different time frames. The question is, Camarilla MACD indicator unique to Admiral Market? No, it's not Camarilla MACD, it's not indicator. I will respond these questions, then I will respond to questions after I finish with webinar. So the Camarilla MACD is not indicator. Camarilla is indicator. MACD is indicator. Camarilla MACD is my unique and proprietary trading method where I give you guys those trades, and when I give you those free pips. That is Camarilla MACD. It's my method of trading. And it's unique to Admiral Markets because Admiral Markets webinars are the only webinars those session recaps where I actually give the free pips to everyone. So because I work with Admiral Markets, this is the part, of course, of the deal to actually empower the traders with powerful analysis and actual trading ideas. So let's get back to MTF. So when I use a multiple time frame analysis, I always take into consideration those higher time frame entries. Higher time frame entries actually are giving me the better chance to view the trade ideas from a better perspective. The thing is, what you need to know is that trend is actually, you know about it already, but I need to remind you, trend exists on each time frame. Now, let's get back to basics. What is the trend? I will repeat you guys always because you need to learn proper way. Maybe you're visiting other webinars, maybe, I don't know, whatever, but I always give you the most possible, the easiest explanation definition. This is the trend. Okay? This is the trend. This is not a trend. When price goes directly, this we cannot talk about the trend, because every trend has a retracement. Okay? And this is a proper trend. This is much untradable when you see something like this or this. But this is very good trend, zigzag or this. So that is a trend, a series of thrusts and pullbacks. Remember that. So trend can exist on 1 minute time frame, on 5 minute time frame, on weekly time frame, on monthly time frame. So remember that, guys. Trend exists on each time frame. For a proper multiple time frame analysis, we need at least 3 scans of various time frames. So we need, let's say, daily 4 hour, 1 hour, 4 hour, 1 hour, 15 minutes. That is how it usually goes. We need at least 3 scans of various time frames. Now, 1 minute to 5 minutes, we call it scalping. 15 minutes, we call it scalp or scalp swings. 30 minutes, we call it intraday time frame. 4 hour, we call it intraday or intra-week time frame. Then we have daily, which is actually intra-week or intra-month trading frame, and weekly or monthly chart, which is actually investing time frame. So these are the explanation, guys, of various time frames. And now, pay attention to this, what I'm saying. If you actually trade only one single time frame, you would be scalping or doing scalp swings or doing intraday trades or doing intraday, intra-week trades or doing intra-week, intra-month trades or doing investing. That is when you actually take only one time frame into consideration. Now, what happens if you actually combine all of those possible trends, momentums, and actual cherry picking the entry? What can happen is you basically are using high time frame momentum, high time frame trend to actually trade lower time frames. I will repeat this again. If you're trading only this, or this, or this, or this, or this, you're actually trading momentum and trend on a single time frame. Okay? Single time frame. If you're watching 3 time frames, then you're actually taking into consideration trend, momentum, and entry. You are using higher time frame trend, higher time frame momentum, and lower time frame entry. So basically you are aligning trend, you are aligning momentum, and you are aligning a loss of momentum to actually trade into the trend. Now this might sound a little bit confusing, but I am sure that you are following me with this, guys. I'm really sure that you are following me with this. I see new traders are coming into the room, so I will repeat, because this is this is important, guys. Listen to me now. When you're actually trading higher time frames, you are aligning trend, you are aligning momentum, and you are aligning entry. Why does it look like this? Because when you see a trend, okay, this is trend. Now this is momentum, strong, it's going down. And actually lower time frame will give you a loss of momentum. Loss of momentum means, I taught you that already, a loss of momentum is called a retracement. So actually you won't be selling into supports. You will be using a loss of momentum or so-called retracement to actually get in within the momentum and within the trend. That is what actually higher time frame is all about, guys. That is what actually higher time frame is all about. Now you know what I'm talking about. You understand what I'm talking about, guys. That is it, guys. Actually, if you're doing higher time frame analysis and trading, you will be in a better chance to get into the trade, into a good early trade. In that case, you need to protect your profits. And in that case, you can have a nice target, much better than if you did, let's say, with only one time frame, if you don't know what you're doing. But always pay attention to higher time frame. If you're trading intraday, you watch 4 hours, of course. But you can take entries on 1 hour. Actually, Camarilla MACD does not use multiple time frame trading. But one of the principles I use in Camarilla MACD is analysis. If I do the analysis on 4 hour, I will take the entry on 1 hour time frame. You probably noticed that from my analysis. When I do 4 hour analysis, I will do 1 hour entry. And one of the principles I will talk about today is using 4 hour trend, 1 hour momentum, and 15-minute loss of momentum to actually get you in the trade. So trend, momentum, a loss of momentum. You're aligning three things to give you powerful entries. Okay? Now pay attention. 1 minute to 5 minutes, we call it scalping. We already know about it, right? So we call it scalping, guys. 1 minute to 5 minutes. The advantages, now I'm talking just about single time frame. So I will tell you about single time frame advantages and disadvantages. Okay? 1 minute to 5 minutes, if we do trading or that time frame, we call it scalping. The advantages of scalping are there are a lot of chances to trade, there are less chances of losing trades, and no overnight risks. Now actually, guys, I hope that, and I was talking with Admiral Market Support, of course, and the thing is, I actually told them that spreads on sub pairs are a little bit high, and I think that the spread should be lower, because if you see a good trade on GBP Audio or GBP Swissy now, it's impossible to scalp, just because of that no commissions. Now there are no commissions, just because of spread. So basically, if you do scalping, the first thing is we need to have good spreads. Everyone needs to have good spreads. So actually, when you do scalping, spreads should be good, and then you need to pick the pairs which have good spreads. Now that is the disadvantage of scalping. If you cannot scalp with big spreads, you cannot scalp if spreads are more than 4 pips, because you will have more cost to pay and your risk to reward will be very poor. So there is actually no way to take scalping on time frames which are not time frames, on trades which actually, on pairs which have big spreads. This webinar is recorded and everyone, you can replay and understand it better, of course. So guys, also when you do 5-minute scalping, it will be mentally difficult for you sometimes because there is a bias change. You will eventually be going from long to short trade and you wouldn't know what you're doing. So scalping can be a little bit frustrating, but for those who are actually good into scalping and who actually know how to scalp, well, that can be pretty much rewarding. And limited profits, of course. For scalping, profits is a little bit limited, but the thing is, for those scalpers who are actually very sure in themselves and in the system they're trading, profits can be pretty much great. 15-minute scalp swings are actually a little bit better than scalps, because if you do 15 minutes, we cannot say 15 minutes is intraday trading, but we cannot also say that 15 minutes is scalp. That is why I came up with a term, and this is the term which I think I'm the only one who uses this term. It's called scalp swing. So actually, if you do scalp swings, then you're actually trading something in between the intraday trades and scalping. It's called scalp swings. Scalp swings offer us a lot of trade opportunities. They offer us less chance of losing trades. We don't have overnight risks, and actually we have slightly bigger targets than when we scalp. Okay, that's normal, because on 50 minutes we have a little better pullback than on 5-minute time frame, but also 50 minutes is confined with spreads. Again, if you're trading off 15 minutes, you can't actually take 5-6 spread because you have more cost to pay and your target is actually a little bit lower and you need to constant babysitting. Now, I'm sure that you know how buying and selling work when you do forex trading. I will repeat it again for all of you who actually don't know. Let's say that you have 4 pip spread on a pair and you want to actually buy that pair on this level, 1.5000. So actually you need to add the spread to buy that price level. So if you want to buy 1.5000 and you have 4 pip spread on that pair, you will actually making a pending order and buying at this price, 1.55004, okay? Because you need to add the spread when you are buying. You don't need to add the spread when you are selling, but usually when selling, spread is add to stop loss, okay? So these are the rules of trading. Now, it's most obvious that if you want to scalp, you cannot scalp with 4 pip spread because your target is 10 pips and you're actually, when this goes 10 pips in your direction, you will be actually taking 6 pips. That's not good. So you need to go and move on a little bit higher time frame. But yet again, 15 minutes, you can do with 2 to 3 pips spread, but then 4 and more pips spread is just not suitable for 15 minutes. So again, spread is a little bit difficult to manage on 15 minutes, and you need to constantly babysit the trade. Constantly babysit the trade. Okay? Then, 1 hour intraday time frames. Advantages are suitable, it's suitable for both full-time and part-time traders. There is a less chance of losing trades, the targets are bigger, and we actually use trailing stop. Okay? We actually are using trailing stop, guys, when we take those trades. Because 1 hour time frame can give us not just better targets, but it also can give us the possibility of using trailing stop, which is actually great thing, because trailing stop usually saves us from losing the money, and it can save us from reversing the trade. The targets of 1 hour time frame are definitely bigger than 5 and 15-minute time frame, and disadvantages are overnight risk. That sometimes happened to me, and it happened to me a couple of days ago on Audi New Zealand, but it's the risk we need to take into account. The thing is, sometimes when we do overnight trades, they can stop us out without knowing. And that is called overnight risk. The thing is, very often I use trailing stop, and I don't care if my target goes 15 pips or 25, 30 pips. I use trailing stop usually when I see a loss of momentum, or when I see that there is impending news coming, or when I do counter trend trade. So that is why I use trailing stop. Overnight risk is something we need to deal about. Obviously, when we trade overnight, we don't have a control over our entries, over not entries, we can use pending orders, but over our exits and trailing, because we cannot use trailing stop. We can use with those expert advisors, but the thing is, sometimes during the night you just cannot see that momentum. I always look to watch at momentum to actually put the trailing stop in. So overnight risk is disadvantage of intraday trade, because sometimes your trades can become 2-day trades. We do exit overnight. We cannot exit overnight. So, for example, if we are in profit 20, 30 pips and we are still sleeping and the target is not hit, then bang, it can reverse and hit our stop loss. And it can be a swap if we trade multiple pairs. Swap is actually very nasty for some pairs, so you always need to read the swap table if you want to do overnight trades. But usually 1 hour intraday time frame happens during one single day, but occasionally it can cross to 2-day trade. The question, I need to answer this. Maybe you know why Admiral Markets frees server for 15 minutes every night. No such thing on other brokers. Yes, the thing is, it happens at 11:54, and that is the time. Just give me a second, please. At 11:54, that is actually time when Admiral Markets do clearing. So basically, they are probably clearing the orders, and that is 15 minutes pause. But that is not a problem really, because usually during that time, I occasionally have trades during that time. But you know, you have your trailing, you have your stop, you have your target, and why that happens is probably they do clearing, but it won't affect your trading. You see, it's basically overnight, and they're closing and opening 15 minutes after the midnight stop. Actually, it's okay. It doesn't matter. So that is not a big deal. That is not included in the overnight risk. It doesn't affect us really. If we have a nice stop loss and whatever, usually in that particular time there is no huge trading going, and actually price does not move very much during that time. Usually it happens each night. So basically it's not a problem. At least for me it's not a problem, because if I have the overnight trade, I always trade with stop loss. Sometimes it can move in not move. It can move in my direction, but usually the trade is there where it was before that 15 minutes close. So actually is a part of their work, and you don't have to worry about it. But you don't have to scalp in that particular time. If you followed my webinars, either you can leave the trade if you have order opened, but you just don't open any trades after 10 o'clock. If you want to trade Asia, then either you have a trade from London and New York, which is basically carried overnight, or you want to actually get up at 2 a.m. and trade Asia session. If I trade Asia session, I usually 100% the time I have my trade carried from London and New York session. Time zone is GMT plus 3, so it's actually 10, okay, I will talk in my time. It's GMT plus 2, sorry, GMT plus 2, so it's actually 10:54 p.m. or 10:54 GMT plus 2. On trading platform, it's 11:54, which is actually GMT plus 3. And yeah, at 3 a.m. or 2 a.m., depending, it starts Asian movement. So actually, if you want to trade Asia, then it's up to you. As I'm saying, I usually carry my trades. If I have a London or New York trade carried over, then there is a time when I trade actually, but it's not trade Asia session. I actually carry the trade from London or New York to Asia. Sometimes it happens during the Asia session that we have a big swap, but that is something which we also have to deal with. But intraday time frames are my time frame of choices. Then we have 4-hour or daily time frames. The advantages are it's suitable for part-time trading and limited investing. We have bigger targets for 4-hour and daily trades. We can use trailing stop, and we can use pending order, guys. We can use pending orders. But disadvantages of 4-hour and daily trading are, again, overnight risk. Then, in addition to overnight risk, we have a macroeconomic risk, which actually is not good to be into, because, you know, we can experience some sudden changes during the night, and we actually might get stopped out after 3 or 4 days in a profit, and that is not good. Then we use bigger stops, which is obviously disadvantage. Even if the risk is 0.5, it doesn't matter. Still the stops are bigger and the trades are slower. We need to count in the swap. So if we have a negative swap rate, then we will lose the money each night, no matter how our trade is going. We need to pay for that swap. It's overnight rollover, and it's pretty slow. So it's, again, for me, trading 4-hour and daily, I don't do that. I trade each day. I put the trades in, put the trades out, managing the trades. So actually, I'm not worried about these little nasty things which can happen when trading higher time frames. Weekly and monthly trading, obviously advantages are investing. You're actually investing. Well, if you like to invest, then you will trade weekly or monthly. I don't do that. Weekly and monthly time frames are not prone to intraday movements. They are news proof. That means that everyday news definitely do not affect weekly and monthly time frames. NFP completely is negated. All of those intraday, intra-week, intra-month news are definitely taken out. We don't, it doesn't, it's actually irrelevant to weekly or monthly time frame trading. Fewer transactions, less spreads. You usually make 1 or 2 transactions per month or year. Not per month, per 6 months or year. And trades take weeks, months, or even years. Macroeconomic risk, its disadvantage, because macroeconomic risk can change the target during those months. And actually what is more important, sometimes natural disasters. You remember the earthquake in Japan? When yen was getting so strong, so many traders lost their accounts back there in time. It's very bad thing to happen, guys. Then we usually, those who are trading on weekly or monthly, they do not use stops, or they use huge stops. It's called time stop or equity stop. Then again, it's swap. If trading multiple pairs, well, even if you trade only one pair, again, it's swap. It's very slow. Trades takes weeks, months, years to develop. The swings are so huge. 1 or 2 trades per 6 months. You need bigger account for that. And occasionally losing months can stop you out if you want to trade weekly or monthly. I never trade weekly or monthly. And I'm against it because it's sort of investing. I invest in other things. I don't invest in higher time frame trading, really. Now, why should we use multiple time frame analysis? The question is what I think about 30-minute time frame. 30-minute time frame is okay. I occasionally use it for breakouts. Why use multiple time frame? First of all, aligning the trends. That's a good thing, aligning the trends. Aligning the momentum. Aligning the targets, aligning the stops, and cherry-picking entries. So these are definitely guys, these are the rules for multiple time frame trading. Again, I will be repeating. With multiple time frame trading and analysis, you are actually aligning the trend. Okay? Then again, you're aligning the momentum. If momentum is going down and the momentum is strong to the downside, then the price will push to the downside quick. You can align the targets. Targets are obviously down, but because you are trading multiple time frame, targets are bigger. Aligning the stops, which goes in confluence with cherry picking the entries. Loss of momentum leads to retracement. That retracement is giving us better entry, and according to that entry we are actually placing our stops. I will show you that on the example. So why you should use multiple time frame? You are using higher time frame trend for trading the price. You are using higher time frame momentum for trading the price. Usable only within trend trades. So you actually want to do trend trades. You don't want to do anything other than trend trades. The larger the time frame, the more likely an important support or resistance levels would hold. And we do use bigger picture for trading. Pay attention to this, guys, now. This is actually Aussie New Zealand, okay? Now, I occasionally use, I don't know, this is the mistake. I put 2 MACDs. Actually, it should be only 1 MACD, but it doesn't matter, guys. It's only about 1 MACD, not 2 MACDs. So what I want to say is now pay attention. Everything will be clear, guys. I think that you remember my webinar about MACD. Chloe says second is bonus. Yeah, second is bonus. Remember, when MACD is going up and it's above zero line, we say that momentum is to the upside. When MACD is up, is above zero line, but that line, the lines are crossed, we are still saying that the trend is up, but there is a loss of momentum. Okay, you remember that webinar about MACD, and this is the thing. Now you can combine MACD with price action. This is price action. Swing, this is swing, this is swing, this is swing. Obviously, from this point on 4-hour time frame, we had switch of the trend. Basically, MACD went down. MACD is going down here, and we see that this trend line, which is very steep, has been broken. So we can say that 4-hour is trying to place a new trend, downtrend. The same thing we see, this is the same spot, this vertical red line. Now this is 1-hour time frame. What does it say? Look about this. MACD is crossed, so actually we have a downtrend in Aussie New Zealand. This is the start of downtrend, the cross and the swing. This is actually momentum, which is to the downside, and 50 minutes is a loss of momentum. That is the time when we are making the entry, guys. Okay, so trend, momentum, entry. Trend, momentum, entry. Now the sequence is, this is the idea of multiple time frame trading, and next month I will be presenting you multiple time frame system. So the idea is trend, momentum, a loss of momentum, or entry. Pay attention. This is, just watch the price action. We had a nice trend line over there, and that trend line, yeah, it was too steep, but again it was broken. Look at this double bottom, it was broken at this point. So this is the start of downtrend. Also MACD is crossing down, so actually this is the start of downtrend. It's very clear, guys. Move to 1-hour time frame. Momentum, it's to the downside. Red above blue, it's going down strong. Look, it's strong, and still downtrend. Swing high, swing low, lower high, and we are thinking about new lower low, right? But we do on 15 minutes cherry picking the entries. We need to have loss of momentum. A loss of momentum is actually called a retracement. MACD is going from, look at this, cross of MACD. Now the blue is above, red it's below the zero line. Look. And we put Fibonacci from the top to the bottom, and then bang. Confluence, 50 retracement, trend line, and pivot point. Look how MACD is giving us trend, momentum, and possible entry point. Trend, momentum, and loss of momentum. It should not go pretty much above the borderline, but at this point we can see the confluence. So we actually can assume that the trend will resume from this point. And it's 50 fib retracement, and it's actually we have a trend line. Okay? Now, the idea for multiple time frame trading is, for intraday trading, usual idea is 4-hour, 1 hour, 15 minutes. 4 hour for trend, 1 hour for momentum, 15 minutes for a loss of momentum. I don't use 30 minutes for the entry. Actually, in this kind of trading, multiple time frame trading, you use 4 hour, 1 hour, 15 minutes, not 30 minutes. 30 minutes is actually the time frame where breakouts can take place. And on my Camarilla MACD method, 30 minutes is the time frame for actually taking the breakouts, not trading. I personally use 1 hour time frame for entries, but that's Camarilla MACD. But on this kind of trading, MTF, sorry, this is how it should be done. These are the principles which William Blow described in his book Momentum. Oh, now my tongue. I lost my thought. Momentum divergence. Well, I will look at it now. Let me pause the screen for a moment, and I will show you how it's actually called. So William Blow. Let's find it. William Blow. William Blow. The direction divergence, something like that. Divergence. Let's see, maybe. Yeah, that is momentum direction divergence. That is what I was talking about. So guys, this is a famous trader, and when I started to trade, I read his book, and from that moment on, I decided to use MACD. So William Blow, you say, is a trader with expertise in momentum indicators and their applications. His articles has appeared in technical and stocks economics and so on and so on. Momentum direction divergence. So these are the principle, guys, of momentum action divergence, direction and divergence. 4 hour, 1 hour, 15 minutes. And actually multiple time frame idea for using MACD this way, because MACD is a momentum indicator, is spot the trend on 4 hour, spot the momentum on 1 hour, and spot the loss of momentum retracement entry on 15-minute time frame. 15 minutes. Actually, next time I will be presenting you the system, and it is an effective system to trade multiple time frames. Now, obviously, you would ask me why I don't trade this kind of system if I trade. Because I am the creator of Camarilla MACD. Camarilla MACD uses the principles from William Blow's book, Momentum Direction Divergence, but I have modified it to suit my trading style and to suit every kind of market. I can do scalps, I can do swings, I can intraday swings, I can do breakouts, and I can do counter trades on a single template with Camarilla MACD. But some of the principles from William Blow are taken into my Camarilla MACD. Okay? Some principles. Now, I have come up with this kind of multiple time frame system, so I will be showing you next time. That is the idea, so you can, of course, always modify it. You can try to demonstrate it, use it. But it's actually, we'll use the principles from William Blow's book. The sequence should be observed as price action or MACD. If you observe price action, it's actually pretty clear that from this point we have double bottom, triple, quadruple bottom, this, and it was broken. So the trend started to go to the downside, which was actually a signal also from MACD. Then the momentum is pretty much to the downside, look at MACD, and entry is loss of momentum retracement, which actually is happening here. So loss of momentum on 50 minutes time frame indicates a valid entry. So these are the principles of multiple time frame ideas. Sign up for next webinar of MTF. When it happens, I will be scheduling it for November. So guys, if you have any questions, you can ask me now. I hope that you actually, let me see this, that you actually taken some of the trades I gave you. This particular trade was good for 20 pips, and now it came to break even. Now the only thing why this trade came to break even is FOMC, guys. The market now is waiting for FOMC, and if you have taken this trade, actually it's good. I also wanted to analyze New Zealand yen trade because I had a signal on MACD which gave me a nice divergence on support. I traded New Zealand yen, and basically New Zealand yen gave me some pips, but again market is low and market is waiting obviously for FOMC, so I don't want to risk anything. But the thing is, no New Zealand dollar, New Zealand yen. I traded New Zealand yen today, and I was thinking about giving you, I just couldn't make 3 analysis, and I gave you GBP dollar, I gave you AUD, because this trader asked me about AUD. But the thing is, New Zealand yen also showed nice divergence, and I actually took the trade. But you know, the spread is now 4 pips on New Zealand yen, so we need to be actually careful about those pairs, especially when we have important news, FOMC today. And Aussie, I'm waiting for this. I will be waiting for maybe a bigger pullback. So we will see what will happen. But actually, on Aussie, if you're watching Aussie price is coming to our entries here. But you know, this is POC. Now the price is currently at POC. But the thing is FOMC. The only thing I don't like to take trades now is FOMC, which will happen in 1 hour. So guys, who knows what might happen. It's better actually not to take trades now than to trade it. But it can shoot out from this point. Okay? So that was my trades, my analysis. Also yesterday we had actually, let me see. Yeah, this was AUD, okay, and GBP, the same one. But I will be making, of course, new analysis tomorrow, so we will see. Yeah, you're not is asking, can you please show 3 time frames in example again? Yes. Time frames. Trend. So this is the trend, 4-hour time frame. 1 hour momentum and 15-minute loss of momentum. Usually that 15-minute loss of momentum is called retracement. And now again, I didn't invent this. I always need to pay respect to those who made it. And this actually is again from William Blow, which was described in his book Momentum, Direction, Divergence. So 4 hour for trend, 1 hour entry, and 50-minute time frame. 50 minutes for loss of momentum, which is called retracement. I hope that you have. Any ideas why Euro Yen makes such moves now? Euro Yen, I told you 2 days ago to sell, and it was good sell. But now again, Euro Yen is, you know, when Yen is getting strength, Euro Yen will go down. The thing is, Euro Yen is actually now on intraday time frame is pretty much bullish. So the thing is, why it's making such moves from technical perspective, those moves could be expected, because let me show you. Let me pause the screen and I will show you. I will show you my Euro Yen analysis, which actually, let me see Euro Yen analysis. Oh, where is that Euro Yen? Okay, and I will tell you then why. Euro Yen. This is October 7th. If you remember this, guys, from yesterday, we had nice pips from this one. It actually broke this M and went down. And what does it say? Upside breakout trade only here. Now, I don't use fundamental analysis so much in my trading, but I use levels. Look at this. Trend line, 1 touch, 2 touch, 3 touches of a trend line. Perfect trend line. M bearish. M bearish came to 55 yesterday after breaking 136.90. So it made some 35 pips. Then it came to this point. It was rejecting here. But then it broke this level. So if you want me to answer that question, I will tell you, because it broke intra-week trend line, it broke H3 on Camarilla, and it broke quadruple top almost here. And it's normal now to shoot up. And that is the question. Retrace, yes. Retrace is possible, but I didn't do euro-yen analysis today. So if you use your own system to trade, you can take long entry on retracement. Yet again, I will be careful today just because of FOMC. Okay? Maybe tomorrow I will come up with euro-yen analysis. But actually, I will be shorting euro-yen, if you ask me. I will be shorting euro-yen if it comes to this point, guys. This was yesterday, H4, and I will be selling here. I am giving you the entry. The entry is around 138. I will be shorting if it comes there. Because now we have pretty big move to the upside, and I'm sure that 137.95, 138 or 138.05 will be a sell. So I have my pending at 138 here. I want to sell it there. Counter trend trade. So we will see if it happens. So thank you, guys. If you don't have any further questions, thank you. Great knowledge. We wait for second part. Thank you, Tibai. Thank you, Lo. Thank you, guys. We need to be careful, as I always say. Be patient. Profits always come to us, but we need to be patient, and we must not risk too much. If we risk too much, it's only the matter of time when we will lose too much. Remember that when I teach you. Remember that for always. Because sometimes, you know, guys, when you trade, you will have responsibility to your family, to your friends, to your girlfriend, boyfriend, whatever. And just imagine if you lose 30% in a month, as some traders do, and then it's impossible to make it up for a short time. Because you need to risk much. And you know what happens when you risk much? You lose even more. Okay? Thank you for attending. Thank you for nice comments. I will talk to you soon. Pay attention to FOMC. I will try, as I said, to short into 138 on euro-yen. So we will see what happens. Thank you for listening to me. And I will talk with you soon. Cheers.